Hello everybody. Today we have published the latest edition of our Global Monetary Conditions Monitor. In the monitor we focus on something very special, I think, that is on top of the mind of a lot of participants in the financial markets globally, and that is what is happening on the currency markets, and particularly what is happening to the euro dollar. We have called this in the monitor the Great FX Reshuffle. The interesting thing is that if we look at all monetary conditions globally, they more or less changed from a month ago. Global monetary conditions seem to be in a bit of a sweet spot. Globally, our forecast for two-year inflation is around 2.5% globally. That is also more or less the average for the 26 countries inflation target, which we cover in the monitor. So the overall monetary policy globally is pretty much where it should be. However, if you look at the larger central banks, the Fed, the ECB, the People's Bank of China monetary policy is generally slightly too tight. But the interesting thing is, among these global monetary superpowers, we're having a reshuffle. And the reshuffle is really much driven by what we're seeing in the euro dollar. The dollar is weakening, the euro is strengthening, and that is the big story in the global financial markets. And that is also changing our topic, what is the main focus of our monitor. A month ago, we said in the headline of the monitor, Mrs. Yellen, please ease up a bit. And Mrs. Yellen has actually listened to us, or rather, the global financial markets have listened to us, in the sense that the dollar has been weakening further over the past month. This is easing monetary conditions in the US. Consequently, we're now seeing a little bit higher inflation out in the medium term. Our two-year inflation forecast for the US has inched up from 1.8% to 1.9%. Indicating that the Fed is getting closer to hitting its target in the medium term. Hence, we still consider the need for some monetary easing in the US relative to market pricing, but not as much as a month ago. Contrary to that, the ECB is now facing some headwinds. Since the ECB introduced its QE program in early 2015, monetary conditions have been developing quite favorably in the Eurozone, and we have from some time been arguing that the ECB was actually on the way to deliver on its 2% inflation target. However, for the first time since the ECB introduced QE in January 2015, monetary conditions are now tighter in the Eurozone than in the US, measured by our monetary indicator for the two regions. That means that our focus is shifting towards the ECB from the Fed. The ECB needs to step back, and that's why we have the headline this month on the monitor, Mr. Draghi, please ease up a bit. How could he do that? Well, he has an opportunity at the next Governing Council meeting of the ECB on September 7th. He could be slightly less aggressive in terms of tapering of the QE, in terms of scaling back QE. He could send a signal that he's worried about the euro strength. Doing that, in our view, could put the ECB back on track. But again, this signals that the risk on inflation seems to be on the downside, both in the Eurozone and in the US. We are nearly getting to where we ought to be, but central bankers are still a little bit too aggressive. But also read the monitor for other countries where we are seeing interesting things. We are focusing a little bit on Switzerland. We are arguing effectively the Swiss Central Bank over the past 1.5 years has introduced a new form of exchange rate policy, essentially stabilizing the nominal effective exchange rate of the Swiss francs. We are also arguing that the Swedish krona, there's room for strengthening of the Swedish krona with the Riksbank having too easy monetary conditions. The Riksbank really ought to tighten. Really one of the only developed countries where we need to see tightening rather than easing. Sweden is interesting, we cover that in the monitor, and we will follow up on that story tomorrow. Bye.